Welcome to G Fun Facts Online. Today, we're talking about one of the most powerful, yet least understood institutions in the world, the central bank. You might know it as the Federal Reserve in the US, the Bank of England, or the European Central Bank. These institutions hold immense power. Their decisions can make your mortgage cheaper, your savings worth more or less, and can even influence whether you have a job. And at the heart of their power is a single, crucial principle: independence. The idea is simple. To make the best decisions for the economy, a central bank needs to be free from the day-to-day pressures of politics. But is this really a good idea? Should a group of unelected experts have so much control over our financial lives? Today, we're diving deep into the world of central bank independence, a concept that acts as a core pillar of modern economic stability. Let's start with the basics. What does central bank independence, or CBI, actually mean? It doesn't mean the bank operates in a secret bunker, accountable to no one. Think of it more like a structured delegation of power. The government, which is elected by the people, sets the big picture goals. Typically, these are things like keeping prices stable, meaning low and predictable inflation, and aiming for maximum employment. The central bank's job is to use its toolbox of technical instruments to achieve those goals. This is where the independence comes in. The most common and widely accepted form is called instrument independence. This means the bank is free to choose the best tools for the job, like setting interest rates or buying and selling government bonds, without a politician calling them up and telling them what to do. There's a less common version called goal independence, where the bank sets its own objectives, but that's quite rare. This freedom is protected by a few key dimensions. First, there's political independence. This is about shielding the bank's leaders from short-term political cycles. You achieve this with specific laws about how the bank's governor and board members are appointed. They usually get long, staggered terms, so their tenure doesn't line up perfectly with election cycles, and there are strict rules for their dismissal. You can't just fire a central bank governor because you disagree with their interest rate decision. Next is economic independence. This is critical. It's the bank's ability to say no when the government asks it to simply print money to pay for government spending. Historically, whenever central banks have been forced to finance government deficits, it has been a recipe for runaway inflation. Then there's personnel independence, which ensures the bank's leaders are appointed based on their expertise, not their political connections. Finally, there's financial independence. The central bank needs to manage its own budget. This prevents the government from threatening to cut its funding as a way to influence its decisions. So why go to all this trouble? The main reason is to solve something economists call the time inconsistency problem. This idea was so important it won its creators, Finn Kydland and Edward Prescott, a Nobel Prize. The problem is this: politicians have a natural temptation to go for short-term gains, especially before an election. Imagine a government wanting to create a mini-boom. They could pressure the central bank to slash interest rates and pump money into the economy. This might create jobs and make people feel good right before they vote. But it's a trap. If businesses and workers expect politicians to do this, they'll start demanding higher wages and prices in anticipation, preparing for the inflation they know is coming. In the end, you get a vicious cycle. You end up with higher inflation but no real sustainable boost to the economy or employment. An independent central bank, with a long-term focus and a clear mandate for price stability, acts as a credible promise to the public that it won't play these short-term political games. This helps to anchor inflation expectations, making the entire economy more stable. The idea of an independent central bank isn't new. The first central banks, like the Bank of England founded way back in 1694, were actually private companies. Their independence wasn't based on some grand economic theory, it was just practical. They had a government charter, but they were largely free to run their own affairs, with their main job being to ensure their paper money could always be converted into gold. But the 20th century changed everything. The chaos of two world wars and the Great Depression led governments to take direct control. They needed massive amounts of money to finance war efforts and manage shattered economies, so they nationalized their central banks and put them under the thumb of the Treasury. In the US, for example, the Federal Reserve was forced to keep interest rates artificially low to help finance World War II. This political control continued after the war and contributed to a surge in inflation. The tide started to turn back in the 1950s. The 1951 Treasury-Fed Accord in the US was a landmark agreement that gave the Fed back a degree of independence. But the real catalyst for the modern independence movement was the global crisis of the 1970s, known as stagflation. This was a toxic mix of high inflation and stagnant economic growth that baffled economists and politicians. The old idea that you could trade a little more inflation for a little less unemployment fell apart. At the same time, countries like West Germany, whose fiercely independent central bank, the Bundesbank, had an amazing track record of keeping inflation low, provided a powerful example of a better way. Starting in the 1980s, a wave of reform swept the globe. Countries from New Zealand and the UK to emerging markets in Latin America began rewriting their laws to give their central banks more autonomy. Central bank independence became a cornerstone of modern, sound economic governance. So the theory is compelling and the history is clear. But does it actually work in practice? What does the data say? The most robust evidence is on inflation. A huge number of studies, especially from the 1990s and 2000s, found a strong, clear link. Countries with more independent central banks tend to have lower and more stable inflation. A major review of 59 different studies confirmed this negative relationship. However, it's not a magic bullet. The link is strongest in developed countries. In developing nations, just having a law on the books saying the bank is independent isn't always enough. You also need a strong culture of rule of law and stable democratic institutions for it to really work. What about economic growth? Here, the evidence is much more mixed. There's no clear, consistent relationship. Critics argue that a central bank that is hyper-focused on inflation might be too quick to raise interest rates, potentially choking off economic growth. Proponents counter that by delivering price stability, an independent bank creates a predictable environment that is essential for long-term investment and sustainable growth. The jury is still out on this one. A newer area of research, especially after the 2008 financial crisis, is the link between independence and financial stability. Some studies suggest that independent central banks might be better at preventing banking crises. They can implement tough regulations and resist political pressure to bail out failing banks, which reduces risky behavior in the long run. But again, the evidence is still emerging. Despite its widespread acceptance, central bank independence is not without its critics, and their arguments are serious. The biggest criticism is that it creates a democratic deficit. Why? Critics ask, should a small group of unelected technocrats have so much power over policy that affects everyone's job, mortgage, and cost of living? These are fundamentally political decisions, and they should be made by people who are directly accountable to voters. The defense against this charge is to build a system of accountable independence. The central bank is independent in its operations, but it's not a rogue agent. Its goals are set by the elected government. It has to regularly report to the legislature, publish detailed minutes of its meetings, and its leaders have to testify before parliamentary committees and answer tough questions. Transparency is the key to balancing independence with democratic accountability. Another major criticism focuses on who wins and who loses from the bank's policies. Some argue that a relentless focus on low inflation primarily benefits creditors and owners of financial assets, whose wealth is protected from being eroded by inflation. On the other hand, the policies used to fight inflation, like raising interest rates, can lead to higher unemployment, which disproportionately hurts workers and lower-income households. Critics argue this can worsen inequality. The evidence on this is complex and debated, but it's a valid concern about the distributional consequences of monetary policy. Finally, there's the risk of groupthink. insulating a small group of experts can lead to a lack of diverse perspectives. If all the central bankers come from similar academic backgrounds and share the same economic models, they might all share the same blind spots. Many point to the collective failure of central banks around the world to foresee the 2008 financial crisis as a stark example of this danger. So if you want to build an effective central bank, one that is both independent and accountable, what does that look like? The architecture is key. First, you need a clear legal mandate, written into law, that prioritizes price stability. This gives the bank a clear target and a yardstick for measuring its performance. Second, the appointment process for the governor and board must be transparent and based on merit, not political favors. Third, they need secure tenure. Long, staggered terms that don't align with political cycles are crucial, as are strict, narrow conditions for dismissal, like gross misconduct, not policy disagreements. Fourth, the bank must have financial autonomy and be prohibited from directly printing money to cover government spending. And finally, all of this independence must be balanced with strong accountability mechanisms. Regular reporting, public testimonies, and maximum transparency are not optional extras. They are essential for public legitimacy. In recent years, central bank independence has faced new threats. The massive, unconventional policies like quantitative easing that were used after the 2008 crisis have blurred the lines between what the central bank does and what the government does. The rise of populist politics has also led to more direct political attacks on central banks and their leaders in several countries. Furthermore, there's a push for central banks to take on new mandates, like tackling climate change or reducing inequality. While these are vital goals, loading up the central bank with too many responsibilities risks distracting it from its core mission and compromising its independence. In conclusion, central bank independence is not a perfect solution for all our economic problems, but decades of experience have shown it to be an incredibly effective institutional tool for achieving price stability. And price stability is a crucial foundation for long-term economic prosperity. Protecting this hard-won independence, while ensuring central banks remain accountable and responsive to the societies they serve, is one of the great challenges of our time. It's a constant balancing act, but one that is essential to keeping this vital pillar of our economic system strong. Thanks for tuning in to G Fun Facts Online.